Welcome to The Deep Dive. We're the show that goes beyond the headlines, really digging into the details to give you the clearest picture. Today, we're jumping right into a world that, well, it's everywhere now, isn't it? Virtual assets. Bitcoin, Litecoin, Ethereum, these digital currencies, these assets, they've just exploded. They're huge investment vehicles now, completely new ways to exchange value. And the speed, the innovation happening in security around them, it's pretty breathtaking. Feels like a whole new financial frontier opening up. Efficiency, global reach, all that. Okay, but let's unpack this a bit, because like any big technological shift, there's a flip side, a darker side, you could say. This exciting new world, all this potential, it's also attracting, well, let's just say less desirable attention. It's not just a digital gold rush. There's a shadow economy using these same tools.
That's exactly right. And what's really interesting, almost paradoxical, is you hear so much about transparency from crypto supporters, right? This idea that every transaction's logged forever on a public ledger.
Yeah, the blockchain argument.
Precisely.
Yeah.
But despite those claims, the undeniable reality, what we're actually seeing, is that sophisticated criminals are finding ways to exploit these assets for money laundering. Now, is the volume as big as, say, traditional money laundering through banks and shell companies? Probably not yet. The data suggests it's still smaller overall.
Okay.
But it has absolutely become, as some sources put it, the newest and trendiest venue for hiding illicit funds. It's where old-school financial crime meets brand-new tech.
And that creates huge challenges, I imagine.
Massive challenges for law enforcement, for regulators trying to keep up. Many in the crypto world argued for a long time that laundering wouldn't be a huge problem.
Why was that?
Well, their thinking was, the public ledger makes it traceable, and it's complicated, maybe riskier than just using cash.
Right.
But as we dig into it, the reality is it is happening, it's growing, and it's global. This creates a kind of regulatory lag. The very speed and decentralization that's great for innovation
It becomes a tool for criminals.
It's exactly a formidable weapon. It forces regulators to constantly play catch up, moving from just reacting to trying to predict what's next. So our deep dive today, what we really want to unpack for you, is understanding those inherent risks in crypto. How are criminals actually doing it? What methods are they using? And maybe most importantly, what are global regulators? And specific countries will look closely at the UAE later. What are they actually doing to fight back? So for you listening, the mission here is to get a really solid, quick, but nuanced grasp of this whole complex picture.
Okay.
So connecting it all back. What does this shadow activity mean for the big promises of crypto? Does it undermine the whole thing?
That really is the million-dollar question, isn't it? And I think it starts with why people are drawn to crypto in the first place. The appeal. People love it because, well, it often is faster. It's easier for certain things. There's this perception of security, maybe privacy too, sending money across the world in minutes, fewer middlemen, maybe lower fees, that kind of peer-to-peer feel. Traditional banks just can't always match that.
Right. That convenience is powerful.
Exactly. But here's the twist, isn't it? Here's where it gets really interesting. Some of those exact features, the speed, the ease, the global nature, they're precisely what make it vulnerable.
It's a classic double-edged sword.
Completely.
Yeah.
The things that drive legitimate use also open the door for the bad actors.
Absolutely. And to understand how criminals exploit it, we need to look at the fundamentals of virtual assets themselves. First up, and this is foundational, is the total online nature and the pseudonymity it offers.
Pseudonymity, not quite anonymity.
Exactly.
There.
Not true anonymity in most cases, like Bitcoin. You have an address, a string of characters, not necessarily your real name linked directly to it in an obvious way. But every transaction is on the public ledger. But unlike traditional money physical cash, bank accounts meaning ID crypto lives entirely online. Stored online, moved online, traded online, usually across borders, instantly.
Okay.
This digital-only world combined with that pseudonymity creates, well, a perfect storm for money laundering. All three stages.
Placement, layering, integration.
Precisely. Placing the dirty money in, layering it through complex transactions to hide it, integrating it back out looking clean. Crypto's online borderless nature makes old tracking methods really, really difficult.
Because it moves so fast.
So fast, across multiple countries in seconds. It bypasses the usual checks and balances you have in banks. Try depositing a huge amount of cash or wiring it overseas traditionally.
Red flags go up, KYC checks kick in.
Right. Know your customer. They need verified ID. With a lot of crypto activity, especially historically or on less regulated platforms, you could move huge sums with just that pseudonymous address.
But the ledger is public.
The ledger's public, yes, but linking that string of characters back to a real person, especially quickly, and especially when criminals use techniques to deliberately obscure the links, that's the challenge for law enforcement. It's a huge hurdle.
So privacy is good, but also a vulnerability.
It's exactly the double-edged sword again. And future tech. It could go either way. More advanced privacy coins, better mixing services could make it even harder to trace. Or new AI, better network analysis tools for law enforcement could get better at de-anonymizing and spotting patterns. It's genuinely an ongoing tech arms race.
Okay, so that's the online nature and pseudonymity. What's next?
The second massive factor, and maybe the most obvious open door for criminals, is the lack of consistent global regulation, or in some places, any regulation at all.
Compared to traditional banking, which is heavily regulated.
Extremely regulated. Think about it. Banks, brokers, payment processors, they all operate under strict rules.
Yeah.
KYC, AML, anti-money laundering laws, reporting suspicious activity, SARS. It's all designed to prevent illicit funds and create a clear trail.
Right. Layers of oversight.
Exactly. But the crypto world, it's still a patchwork. Vast parts of the market have, as our sources say, little to no regulations, especially historically and still today in certain countries.
Some governments even discourage it, right?
Some discourage it, some ban it outright, which ironically can also drive activity underground. But the key point is this regulatory void, this inconsistency. That's a key attraction for financial criminals.
Because they can operate without scrutiny.
Precisely. They can place and layer funds without triggering the alarms they'd face in the traditional system. It allows for regulatory arbitrage.
Meaning they just move their operations to the countries with the weakest rules.
Exactly. They find the loopholes, the safe havens. So this isn't just a small gap. It's a massive structural vulnerability in the global financial system right now. It makes tracking cross-border illicit flows incredibly difficult.
Okay. Makes sense. And the third point.
The third point comes down to the basic characteristics of crypto itself. Things often seen as its best features, like its global, borderless nature.
Accepted everywhere, easy cross-border payments.
Right. And often more autonomous because it cuts out the middlemen, the banks. Think about sending money internationally through a bank.
Lots of steps. The bank itself, regulators, maybe SWIFT network.
Lots of potential checkpoints. With crypto, especially peer-to-peer or on decentralized networks, the transaction can be much more direct, from one owner's wallet to another's.
So no central authority watching every single move.
Often, yes. That lack of a central intermediary removes a critical layer of oversight. For criminals, that's gold. Imagine moving, say, $1 million across continents instantly.
Without a bank freezing it for checks.
Exactly. No awkward questions, no AML holds, no geographic blocks slowing it down. That frictionless environment is what they exploit.
So when you put it all together online, pseudonymous, patchy regulation, global, fast, fewer intermediaries.
It paints a pretty clear picture of why it's become such a target.
Yeah, it really does. So, okay, we understand the vulnerabilities now. How are criminals actually using these? What are the specific methods? Let's get into the criminal's handbook.
Right. It's not just theoretical. These methods are real, they're sophisticated, and they're constantly evolving.
And interestingly, you mentioned it often mirrors the traditional stages of money laundering: placement, layering, integration.
It often does, yes. But with these unique digital twists. Like you said, an old playbook on a very new, very fast stage.
Okay, so let's follow the dirty money. Stage 1, placement. Getting it into the crypto system. How does that work?
So placement of illegal money is that first step. Turning dirty cash, maybe from drug sales or fraud, into crypto. Launderers do this by buying cryptocurrency, often on online exchanges or peer-to-peer platforms that, crucially, have lesser or no compliance with AML regulations.
So finding those weak spots again. Exchanges in lax jurisdictions or ones that just don't check ID properly.
Exactly. They target platforms where they can trade with minimal scrutiny, avoiding robust KYC checks. They use the illicit cash or maybe even existing illicit crypto from another crime to buy more mainstream cryptocurrencies like Bitcoin or Ethereum.
So that first conversion is key.
It's the critical gateway. Getting the value into a digital form that can be moved easily and obscures the original criminal source, precisely because those upfront checks were weak or missing, away from the eyes of regular banks.
Okay, money's in crypto form now. Stage 2,
Yeah.
layering. This sounds like the complex part.
It is. Layering of illegal money is where they really try to break the trail, hide the origin and ownership. It involves creating distance and complexity. They use structured transactions. Now, this isn't just breaking big sums into small ones, though they might do that too. In crypto, it often means incredibly rapid buying and selling.
Like trading between different cryptocurrencies.
Yes, swapping Bitcoin for Monero, then for Ethereum, then back to Bitcoin, across multiple different exchanges, sometimes dozens or hundreds of trades in a very short time.
Wow.
And crucially, they move the assets internationally, sending funds between wallets and exchanges in different countries, again, often favoring those with weak oversight. It's all about distancing the crypto from its dirty source.
And the speed makes this really effective.
Incredibly effective for them, incredibly difficult for law enforcement. Imagine trying to follow not just one or two transfers, but potentially hundreds of lightning-fast trades and hops across borders, across different blockchains sometimes.
That sounds like trying to untangle spaghetti that's also on fire.
That's not a bad analogy. It creates this massively convoluted trail that's almost impossible for traditional methods or even human analysts alone to follow coherently.
Okay, so after all that churning, stage 3, integration. Getting the money back out clean.
Right, integration or the entry of illegal money as clean. This is the end game, making the washed funds look legitimate so they can be spent. In the crypto world, this often happens when they sell the layered cryptocurrency. A common way is using over-the-counter brokers, or OTC brokers.
OTC, what are those?
Think of them as private dealers for large crypto trades, operating outside the public order books of exchanges. Some are regulated, but others, especially smaller or less formal ones, might operate with less oversight.
Acting as a bridge back to regular money.
Exactly. They can act as that bridge. The criminal sells their clean crypto through an OTC desk, gets paid in regular fiat currency, dollars, euros, whatever, which is then deposited into a bank account.
And it looks legitimate.
It appears legitimate, like profits from trading or investment. Then they can buy houses, cars, invest in businesses, anything, really. The link back to the original crime is, hopefully for them, broken.
Wow. So those are the classic stages, adapted. But you mentioned there are newer crypto-specific methods too.
Yes, absolutely. The digital world has spawned its own unique techniques.
Like what?
Well, one is using online gambling transactions. Lots of gambling sites now accept crypto, right? Online casinos, sports betting.
Sure.
Criminals use their dirty crypto to buy chips or place bets on these sites. The goal isn't necessarily winning big.
It's just to move the money through the platform.
Exactly. They might gamble a bit, lose some, win some, but the main thing is they can then encash it using clean money. They withdraw funds from the gambling site, and it looks like legitimate winnings.
Ah, so the gambling site provides a seemingly legitimate reason for the payout.
It provides a cover story. It's a classic laundering technique, just updated for crypto payments, leveraging the speed and sometimes lower scrutiny on those platforms.
Clever. In a criminal way. What else?
Another method involves decentralized fund transfer networks or just direct peer-to-peer transfers. Remember, crypto can move directly between individuals without always going through an exchange.
Right.
So criminals might transfer large amounts of crypto directly to associates, maybe individuals located in countries with no or weak AML regulations.
Sending it to a safe haven again.
Precisely. Once the funds are in a place with minimal financial oversight, they can more easily convert them. Maybe they buy high-value goods directly with the crypto art, luxury items, or they exchange it for local cash through less formal channels. It's all about exploiting those jurisdictional differences, that regulatory arbitrage we talked about.
Okay. And you mentioned tumblers before. Those sound particularly tricky.
Oh, they are. Cryptocurrency tumblers or mixing services are probably one of the most concerning tools. They're designed specifically to break blockchain traceability.
How do they even work?
Okay, imagine a big digital pot. Lots of different users, some legitimate, some definitely not throw their crypto coins into this pot. The service then takes all these coins, mashes them together, shuffles them intensely. It might involve thousands of tiny internal transactions, splitting and recombining funds.
So it mixes everyone's money together.
Completely mixes it. Then it distributes the crypto back out to the original owners, proportionally, but crucially, to brand new, clean addresses that have no direct link back to the addresses that put the money in.
So you get your value back, but not the same coins, and nobody can tell where they came from.
Exactly. As one source puts it, it puts illegal money into the system, which may go to any participant. It makes tracing the original source incredibly difficult, almost impossible sometimes. It's like a digital washing machine specifically designed to obscure origins.
That sounds like a nightmare for investigators.
It is. It forces them to move beyond just following transactions to analyzing much broader network patterns and behaviors.
Okay, one more you mentioned was ATMs, crypto ATMs.
Yes, the abuse of crypto ATMs. These physical machines are popping up all over the place. You can walk up, put in cash, or use a debit card and buy crypto directly. Some also let you sell crypto for cash.
Convenient, I guess.
Very convenient. But here's the catch. Many of these ATMs, especially those run by smaller, private companies, often have no regulatory structure or legislation controlling them, or their ID checks are very weak, especially for smaller amounts.
So it's an easy way to turn dirty cash straight into crypto without bank scrutiny.
It's a direct on-ramp. A criminal can feed illicit cash into the machine, bypassing the stricter checks they'd face depositing that cash at a bank, and instantly convert it into a digital asset.
And then that crypto can be sent anywhere and layered.
Exactly. It's a really simple, effective way to handle the initial placement of dirty cash into the crypto ecosystem, a physical bridge to the digital shadow world.
Wow. Okay, the methods are clearly sophisticated, diverse, and constantly adapting. It feels like they're always finding new ways to exploit the system.
They're incredibly adaptive.
So what does this mean globally? What are regulators actually doing to counter all this? It feels like a huge game of catch-up.
It often is, yes. And that really brings us to the core question. How are authorities responding? Because doing nothing isn't an option.
Right?
So first, there's this fundamental, urgent need for proactive regulation. It can't just be reactive. Financial watchdogs worldwide have to frame regulations to stop the misuse. But here's the challenge. Criminals are using high tech, moving fast. Regulators need to fight fire with fire. They must use technology to detect these activities as well.
So it's a tech arms race on the regulatory side, too.
Absolutely. Huge investments are going into advanced analytics, AI, sophisticated blockchain tracing tools, trying to spot suspicious patterns, trace funds, even through mixers, maybe even de-anonymize transactions.
Trying to get ahead of the curve, not just react.
That's the goal. Using network analysis to find clusters of bad actors, using AI to predict laundering trends. It's about becoming predictive, not just reactive.
Okay, that's the tech side. What about international cooperation and rules?
That's critical, too. We're seeing significant international efforts, especially led by the Financial Action Task Force, FATF.
They're the global AML standard setter, right?
Exactly. Many countries have already put basic KYC, know your customer, and SAR, suspicious activity reporting, rules in place for crypto businesses requiring ID checks and flagging weird transactions.
Okay.
Some are making specific laws targeting crypto transactions through key channels, like the big exchanges. And interestingly, some nations are seriously looking at creating digital versions of their national currency.
Central bank digital currencies, CBDCs.
Right. The idea there is you might get the efficiency of digital, but with built-in government oversight and compliance, potentially reducing money laundering risks by design.
Interesting. And what has FATF specifically done?
FATF has been huge. They updated their guidance for virtual asset service providers, VASPs, back in October 2021, building on their 2019 work.
And VASPs are exchanges custodians.
Exactly. Exchanges, certain wallet providers, crypto brokers. The updated guidance essentially says these VASPs need to follow similar AML rules as traditional banks.
That's a big step.
It's massive. And crucially, the guidance casts a really wide net. It explicitly covers tricky areas like peer-to-peer transactions, the whole world of DeFi, decentralized finance.
Which is notoriously hard to regulate.
Extremely hard. Also, stablecoins, even NFTs, non-fungible tokens. FATF's trying to close pretty much every loophole.
But how do you even apply bank rules to something like DeFi, which often doesn't have a central company in charge?
That's the multi-billion-dollar question. FATF's guidance tries to pin responsibility on identifiable developers, owners, or controllers of these protocols, trying to find someone accountable in a decentralized system. It's legally complex and still playing out.
So it's a blueprint, pushing countries towards consistency.
Exactly. Urging consistent, strong standards everywhere to stop criminals just hopping to the easiest jurisdiction. Minimize those safe havens.
Okay, that's the global picture. But you mentioned the UAE as a specific example of a country really pushing forward. Let's dig into that. They seem quite proactive.
They really are. The UAE is a fascinating case study. They haven't banned crypto. Instead, they've moved remarkably quickly and comprehensively to regulate it.
Trying to balance innovation with managing risk.
That seems to be the goal. The market there is quite active in regulating crypto money laundering. They seem serious about protecting the system while still allowing it to grow.
So what have they actually done?
It's been a multi-layered approach, happening quite fast. Let's start with the Dubai International Financial Center, the DIFC. It's a major financial free zone.
Yep.
In October 2021, their regulator, the DFSA, Dubai Financial Services Authority, brought in a framework specifically for investment tokens.
Investment tokens, not all crypto.
Right. They define these as tokens that function like securities or derivatives, giving you rights like dividends or voting, different from, say, utility tokens used for accessing a service.
So a nuanced approach.
Very. If you want to deal with these investment tokens in or from the DIFC, you need DFSA approval and licensing. And they've said they plan more rules for other crypto types too. It shows they're really thinking about the different asset classes.
Okay, that's the DIFC free zone. What about the UAE nationally?
Nationally, they adopted a comprehensive framework in September 2021. This came from their top anti-money laundering committee, NMLC-FTC.
Showing high-level commitment.
Definitely. And this national framework explicitly aligns with that FATF Recommendation 15 we talked about. It mandates strict rules for all virtual asset service providers, VASPS.
Licensing, monitoring, compliance.
All of it. Licensing, registration, ongoing monitoring, ensuring compliance. It also includes initiatives to protect the actual infrastructure and guidelines for sanctions. The responsibility for making this happen falls to their main securities regulator, the SCA, and the central bank, a coordinated effort.
So a strong national standard aligned with global best practice.
Exactly. But perhaps the most detailed rules are for onshore UAE, meaning outside those specific free zones like DIFC. This came in November 2020 with the SCA's Crypto Assets Activities Regulation.
Okay, what does that cover?
It's incredibly comprehensive, governs pretty much everything, listing crypto assets, offering them, like ICOs, trading them, issuing them. It applies to marketplaces, exchanges, custodians, crowdfunding platforms using crypto-related financial services, the works.
So casting a very wide net.
Very wide. It clearly defines what types of assets are covered and which aren't. It distinguishes between commodity tokens and security tokens, requiring specific approvals for both.
Similar to the DIFC's approach, but broader.
Right. And any provider doing this stuff needs an SCA license. To get that license, they need strict AML-CFT compliance, data protection, cybersecurity measures. They also generally need to be incorporated locally onshore, DIFC or ADGM.
Ensuring they're properly established and supervised.
Yes. It even covers things like cloud computing use, where data has to reside, and employee standards for these firms. It's detailed.
Wow. And what about the investors themselves?
This is where it gets really interesting and quite strict. Crypto can be offered to qualified investors, typically institutions or wealthy individuals, but even they need SCA approval documented.
Okay.
But for non-qualified investors, basically, regular retail investors, they also need explicit SCA approval before being offered crypto assets.
So everyone needs approval.
Essentially, yes. And the SCA's stance is explicit. They consider all potential investors highly risky in the crypto space.
That's a strong statement.
It is. And it means providers must conduct enhanced due diligence on everyone, not just standard KYC.
What does enhanced mean here?
It means really digging deep, verifying who ultimately owns or controls the funds, ultimate beneficial ownership, checking for geographical risks, screening against sanctions lists, looking for political exposure that might indicate corruption risk. It's a very high bar for customer checks.
Much more rigorous than usual.
Much more. It's a really significant step to try and filter out illicit funds right at the customer onboarding stage.
Okay. And there was one more, ADGM.
Right, the Abu Dhabi Global Market, ADGM, another big financial free zone. They were actually quite early, bringing in rules back in 2018.
Ahead of the curve then.
Definitely. Their regulator, the FSRA, amended their rules to cover crypto businesses. Their approach was practical. They generally regard crypto assets as commodities.
Okay, like gold or oil.
Exactly. Which means crypto operators, their exchanges, custodians need FSRA approval and are then regulated as financial service permission holders. They basically have to follow the same rules as businesses dealing in traditional securities, derivatives, or funds within ADGM.
So integrating crypto into existing financial regulations.
Yes, leveraging their existing robust framework. It shows a pragmatic and early commitment to oversight.
That really is an incredibly comprehensive and fast-moving regulatory picture just within the UAE. It definitely highlights the serious effort going into tackling these risks.
It absolutely does. The UAE has put significant layered provisions in place, no question, and there's always a but in this space. The reality is still that criminals often exploit technology at a higher pace than even legitimate innovation occurs.
The cat and mouse game continues.
It's ongoing. They are constantly looking for the next loophole, the next vulnerability, often faster than rules can be written or systems updated. Still, the progress is real. FATF's global guidance, the detailed work in places like the UAE, these are major steps forward. The key thing, as the sources really emphasize, lies in identifying the red flags at the right time.
So better detection is crucial.
Crucial. Understanding those patterns, the anomalies, the signals of illicit activity, it means the real defense isn't just static rules. It has to be a dynamic, adaptive system using tech, using intelligence to spot those flags when they appear.
And the knowledge we've discussed today helps build that understanding.
Exactly. Knowing the risks, the methods, the regulatory responses, it's all part of building that awareness, which is the first step in effective defense.
So for you listening, trying to make sense of this incredibly complex and fast-moving world of digital finance, what's the takeaway? Well, I think it means staying informed is probably your most valuable asset right now. Understanding both the huge potential of crypto and the very real, evolving risks like money laundering is just vital. Whether you're thinking about investing, or your business is looking at digital payments, or you're just trying to follow the news. And maybe here's a final thought to chew on as we wrap up. As crypto becomes more mainstream and these regulations get tighter and more global, what's the end result? Will these rules eventually stifle the very innovation and decentralization that made crypto so exciting in the first place? Or will they actually create a safer, more stable foundation for crypto to really grow and achieve widespread adoption, finally shaking off that shadow economy? Something definitely worth thinking about.